Financing working capital, bank credit. So in this session, we will see the different ways of providing bank credit. Even before we get there, we know that bank credit is primarily the institutional source of finance in India. So as was explained, bank credit is the basis of institutional finance in India. Also, it is provided by means of cash credit or overdraft, discount bills or purchase bills, securities by way of hypothecation, pledge, mortgage, lien and charge. It's also provided by means of loans, working capital term loans and letter of credit. So in this session, we'll go through briefly each of these items and we will see how bank credit is provided. So the first one is cash credit or overdraft. In this form of credit, the bank specifies a predetermined borrowing limit. The borrower can draw up to the stipulated credit or overdraft limit, and within limit, any number of withdrawals are possible to the extent of one's requirement. Repayments are also accepted during this period. Interest is charged based on the amount that is held by the drawer and not on the sanctioned limit of the amount. However, a minimum amount is charged for the unutilized amount. Always remember that the interest payable in this form of credit is directly dependent upon the amount which is actually outstanding and not on the sanctioned limit. So that is cash credit. Now, what is discount bills or purchase bills? Normally, in the case of cash credit arrangements, unhealthy practices such as double financing as well as borrowers enjoying facilities which are more than their legitimate needs occur. Double financing is because credit was taken on the basis of same good or for the same activity from two or more places. So in bill financing, this would not happen because it links credit with the sale and purchase of goods. Let us examine how this is done. The amount made available as a result of discount bills or purchase bills is covered under cash credit limits or the overdraft limit. Before discounting of the bill, the bank makes sure the genuineness of the bill as well as the credit worthiness of the drawer in most cases will be the purchaser of goods or services. In order to make this scheme popular, the discount rate is kept lower than cash credit mechanism, usually at more than 1 to 1.5% when in comparison to cash credit. The discounting banker asks the drawer of the bill or the seller of goods to accept the bill by the drawee bank or the buyer before discounting the bill. The buyer bank will grant acceptance of the bill against cash credit limit fixed early by it on the basis of stocks and its borrowing value of stocks. This prevents misuse of the bill by the buyer, who now cannot use the same goods as a source for obtaining another bank credit. Hence, according to bill finance, the method of operation of it is in such a way that a bill arises out of trade sale or purchases transaction on credit. The seller of goods or service draws the bill on the purchaser of goods or service, payable on demand or after a period not exceeding 90 days, generally termed as usance period. On buyer's acceptance, the seller offers it for purchase or discount. On discounting, the bank releases the fund to the seller and the bill is presented to the purchaser or acceptor by the bank on due date for payment of the bill. So these are the foolproof methods by which, in the case of discount bills or purchase bills, normally the transactions are carried out. So that completes discount bills or purchase bills. Next is securities. So bank also provides credit and uses the following means, namely hypothecation, pledge, mortgage, lien and charge. We'll see what each of them means. So first is hypothecation. Under hypothecation, the bank or the lender, according to the terms of contract, retain legal right to sell goods to realize the outstanding loan, even though it does not have physical possession of the goods. What is it in the case of pledge? So in pledge, the goods that are transferred as part of security are in the physical possession of the lender. That would mean goods are in the possession or custody of the bank or the lender. The borrower is termed pawner and the bank is termed pawnee. However, pledge creates additional liabilities for the bank as it needs to take reasonable care to protect the property under its custody. Any loss or damage of the pledged property would be the responsibility of the bank. In case of non-payment of loans, the bank enjoys the right to sell the property under its custody. So that is pledge. Now, what is mortgage? In mortgage, it is conveyance of interest in the property that gets mortgaged. The person who parts with the interest is called the mortgager, and the bank in whose favor the mortgage happens is termed as the mortgagee. The instrument of transfer is the mortgage deed. However, as fast as the debt gets paid, the mortgage interest in the property gets terminated. So that is mortgage. What is lien? In lien, it refers to the right of the party to retain goods that rightfully belongs to another party until the debt due to the former party gets paid. Banks usually enjoy general lien that can be applied until all dues of the claimant are paid. So all provisions of a simple mortgage apply in the case of charge on property. The charge is not an interest in property, but it is a security for payment. A charge may be created by operation of law or by acts of parties. A charge need not be made in writing as well as it cannot be enforced without serving a notice. So some differences between lien and charge. Next, we'll see what are loans, how bank credit is extended. So under loans, the entire amount that is borrowed is transferred to the current account of the borrower, on which interest is paid by the borrower on the total amount. The loans remain repayable in periodic intervals or on demand. In working capital term loans, what happens is this arrangement mandates banks to advance loans for 3 to 7 years and remains repayable in installments that are yearly or half yearly. Finally, in letter of credit, the bank credit is extended in this form where bank only bears the risk and the amount is paid by the supplier. That would mean supplier sells goods on credit and extend credit finance to the purchaser, and the bank gives a guarantee and bears risk if there is a default on the purchaser's side. That means the purchaser of the goods or service obtains a letter of credit from the bank. The bank undertakes the responsibility to make payment to supplier if in case the bank defaults. So this completes the ways of providing bank credit. Thank you.